I'm making notes on this that I'll be sharing with you. Don't forget to like, subscribe, and share your thoughts in the comments. Let's keep learning and growing together. Our first step is to pinpoint where we find relative equal highs and lows and understand the concept of draw on liquidity. And we have new week opening gap. Here we had short-term high after 8:30. And before that, market took the sell side liquidity and displaced, taking out short-term high here and here and went to the fair value gap. Our job is to understand how price is booked between old high, old low, and inefficiencies. We have a down close candle after taking sell side, and then we have displacement here. Displacement is basically sudden price move in opposite direction of short-term trend, which is bearish. This high was traded through and came back to down close candle, which is order block. The reason this is good order block, because it formed after 8:30. At sensitive time, algorithm will look for highs and low or inefficiency. We will be using only 3 timeframes in order to mark up our charts with highs and lows with PD arrays: 15-minute, 5, and 1 minute. Look at this high on 15-minute. This is the same high we marked on 1 minute earlier. This is important because it formed a key time, 7 a.m. Time is the most important element to make any areas valuable. Price took out short-term high. Then where will it be reaching now? We have another inefficiency here. And in our journaling purpose, ICT advised to look for how many candles it take to reach there. It took 6 candles from the volume imbalance. Things to look for in relative equal highs where price will be drawn. They should be in close proximity and price should be flat there. If on the other side, price has jagged price action, it tells us that price will move from jagged area to flat areas. Why we should trust the price will take these relative equal swing high. When we have 2 swing highs and left-hand side swing high is higher than another one, this is the high probability swing high, which will be taken out. I cannot stress this point enough. This is absolute gem, and this should go into your notes. Same thing is happening here. We have this high here, slightly lower than the right one. So when the market went like this drop down, this caused sympathetic sigh. Anyone who's sure there, they feel like they almost were stopped out and feel good now because there they will put the stop loss, but it's buy-side liquidity and price will rip through that. A lot of new SMC trader will short this and get punished. So in New York morning session, you should mark up the smooth highs and lows on 15-minute, 5-minute, and 1 minute. Price does not go from A to B in linear way. If price has to go up, it will go down to some efficiency and PD array. Now price has made new relative equal highs, and if you have not traded yet, then look for retracement for new entry. We are on right side of price delivery. Price will respect the PD arrays and rip through those PD arrays, which are on another side. If your PD array fails, then you are trading against the order flow. Let's learn this from one example. We have relative equal lows here, and then market drops. This drops down here, right? And every up-close candle from on this time frame, right there is your breaker, and the most sensitive area of this breaker will the last up-close candle. See how the bodies close above that up-close candle. This is the signature of bullish order flow. All these 3 up-close candle makes the bullish breaker, and most reaction can be expected from the top of the candle. Look inside the price of breaker. All the bodies of the candles closed above the breaker. This is the important signal and gives us narrative that we are in buy program. See how the price is reacting to the FVG. Multiple time bodies of the candle went inside and touched upper side of it. This signals price is still bullish and wants to go up. Remember, price has to come down to go up. We have liquidity on swing low. This back and forth price action makes this range balance. Price has no reason to go down there. And we have breaker below that, sure, which makes perfect scenario for entry now. Time is also on our side. Look at the reaction of price we got from the breaker. We should expect this. If we are on right side of the market, isn't this great? Price moved from 515 to 596 in a matter of 2 minutes. This is what happens, man. When you know how to read the markets properly. Trust me, ICT is a real thing. Just give enough time and you will be amazed. We can see that we have created again high and lower, high, and this one lower, and all 3 of them in very close proximity. Does this make them high probability? Yes, because price made them before 9:30. Time matters a lot. I cannot insist enough. Without right time, they will not be of any use. At 9:30, price went to bullish breaker. Now price will move from internal range liquidity, which is breaker, to external range liquidity, which is this relative equal high, and those sitting above right. The most important factor of trading is knowing where are the stop loss of other trader are located. Initially, price was bearish. Those who are holding their position will place their stop above the relative equal highs. Retails thinks double top as resistance level and algorithm will punish them. So look at this price action now. We had low. Price took the sell side liquidity and make this area jagged. Remember this term jagged? Jagged, I love this term. So on one side, we will having real smooth price action area, and on another side, we will be having jagged price action. Price will move from jagged PA to cleaner, more smooth PA. If you are wondering why did ICT choose these as a final target for drawn liquidity, if you said swing high and lower, swing high to the right, then it's just 50% of answer. The main reason to choose this high, because it formed at 7 a.m. and New York morning session starts with 7 a.m. This is the key time, and you should mark the horizontal line. On 7 a.m., if you trade Forex or futures, it does not matter. New York session starts at 7 a.m. We will start with our analysis by using 15-minute, 5-minute, and 1-minute charts. We will look for smooth highs and lows between 7 o'clock to 7:30, then 8 o'clock to 8:30, and 9 o'clock to 9:30. We can refer to 15-minute once, and then our main time frame will be 5-minute and 1 minute. So in the New York morning session from 7 a.m. to 11 a.m., we have 4 opportunities. Divide every session with horizontal lines and look for those smooth swing highs and lows. So now imagine you have marked the smooth areas on the chart, but they exist on both the sides. Then what shall we do? Then we will wait for one area to be disrupted, and then you have your bias on the other side of disruption. Don't trade into those levels where sharks already have a frenzy, and that's down here. They have already been done here. There has been attack down here, and the way price has been delivered from here, make the price jagged like the teeth of sharks. And we don't have that jaggedness up here. It is nice and smooth. This is why this is our main draw on liquidity. Over the time, your eyes will be trained. Look at here, CB becomes inversion fair value gap, which sends the price higher and it retraces back, and then we have our second leg reaccumulation. Algorithm pushes the price through smooth swing highs, and this completes market maker buy model. Did you see this coming? I don't think so. So our trading framework starts from 7 o'clock, and after that, look for swing highs and low to form. Not before 7 o'clock. Don't use price action before 7 o'clock. Use after 7 a.m. price action. I cannot insist this more. To potentially capture trading opportunities that might be missed on larger time frames, consider analyzing multiple time frames, including the 15-second chart. ICT's methods can help you identify entry points on the 15-second chart, even if you miss them on the 1-minute time frame. On the 15-minute time frame, begin by drawing a horizontal line at 7 a.m. After observing price action post 7 a.m., we might potentially identify the formation of relative lows. However, this is not a guaranteed outcome. We can only anticipate forming relative equal lows if the price begins to rally from this point. Since relative lows haven't formed yet, we won't annotate this on the chart. However, it's crucial to mentally prepare for the potential scenario that may unfold. Post 7 a.m., our focus shifts to identifying potential relative equal highs and lows. It's essential to disregard any highs and lows formed prior to 7 a.m. for this analysis. Shifting to the 1-minute time frame, we begin scrutinizing price action post 7 a.m. for potential relative equal highs and lows. Immediately after 7 a.m., a noticeable relative equal high formed within a tight range, followed by a swift decline as buy stops were triggered. Recall ICT's principle. Price tends to transition from jagged to smoother areas. Here, price took an area which is smooth and make it jagged. And here, price took buy-side liquidity. Within this range, we're on the lookout for relative equal lows. If they haven't materialized yet, we patiently await their formation. A crucial point to remember, we exclusively focus on swing lows forming after 7 a.m. Any lows created before this time are disregarded for our analysis. A subsequent rally would confirm the formation of relative equal lows, establishing a potential target for a potential trade. A price rally surpassing this swing high confirms the formation of relative equal lows. If a subsequent price decline occurs, the pre-7 a.m. low can serve as a potential downside reference point. A critical point to remember. When price has consumed a significant portion of the market's liquidity, often indicated by jagged price action, we ideally want the price to retrace below this area before continuing its downward movement. Ideally, price should maintain its momentum after successfully consuming liquidity. Any retracement back into the area of heightened volatility could potentially signal a reversal and should be monitored closely. Next, we'll identify and mark areas of inefficiency and price movement on our charts, and work our way up from 1-minute chart to higher time frame. So we have SIBI here. We'll also pinpoint smaller areas of inefficiency within the price action. Despite their size, these zones often act as potential turning points. In particular, remaining small inefficiencies within larger gaps are especially noteworthy due to their untapped potential. We will refer to the original fair value gap, but with a focus on determining the remaining imbalance within that zone. If price goes above fair value gap and comes back down, then we can expect the price to come to the top wick of candle already tapped in fair value gap and work as inversion FVG. We also identify a special type of inefficiency with a notable volume imbalance at below. Any inefficient areas accompanied by significant volume imbalance will be included with inefficiency. When identifying fair value gaps in areas with significant volume imbalance, we prioritize the entire price range encompassing the volume imbalance rather than focusing solely on the candle wicks. We disregard the wick in this case. Price reached the upper boundary of the inefficiency, dropped, and formed a new inefficiency. Subsequently, price revisited this new inefficiency, respected its consequent encroachment, and declined further. This is very important, guys. This should go in your notebooks. This specific scenario involves a buy-side imbalance and a sell-side inefficiency, which, according to ICT, often signifies potential reversal patterns. This concept is referred to as inversion fair value gap. Since the market has already reached a significant high before the New York AM session, and considering we're currently in the New York AM session, which is known for retracing back into the London range, buying into this fair value gap is wrong. At this price point, consider when we don't have any price action on the right-hand side. And if we are looking for entry, where did your eye go? Think for a moment. I think that will be this big FVG. But if you want to get better short, we will look for the stop hunt here and the breaker, and from the breaker to the high. Do we have any fair value gap? If there is, then ICT will navigate away from the breaker and look for shorts. From here, consider relative equal low would form in the future for potential target. Price drops from inversion fair value gap and creates another fair value gap, which is good entry point if we are bearish and we have everything in play. If you can notice, there is optimal trade entry, model 22, and we also have relative equal lows for the target now. The very first fair value gap prior to the stop hunt, this is very important. That is why ICT colored him differently. This is change in the direction and what this is doing working as an order block. This is change in the state of delivery. If we don't have this FVG, then we can use the breaker and put the stop loss 2 ticks above the high. We will divide 7 to 10 o'clock and put horizontal lines there. And for every hourly session first, 30 minutes are pre-session where we expect fake swing. In this case, we will want price to go up to go down. We can look for the relative highs and lows prior to the 8 o'clock, but we cannot do this for 7 o'clock because we are trading for the New York AM session range. We have this energetic drop, which created this fair value gap. What else is there? People who were short, they will trail the stop loss there, and algorithm have done the job here and took those out. Price then goes to old fair value gap. And markets break down. Look at the work around halfway point of this fair value gap. Market drops created an inefficiency, and body of the retraced candle is respecting the upper portion of fair value gap, which indicates price is going to go lower. We have relative equal high and relative equal lows, and when we have both, what should we do? ICT taught in last first lecture, we will wait for one to be purged, and then algo will attack on the other one. When we have any inefficiency that's been worked many times, ICT does not want price to reach there. Again, this makes price action low probability. Now he said, even if market from here crashed 1,000 point, he does not want to be the part of this. We will also be measuring the price ranges with Fibonacci extension. So in these cases, we will put Fibonacci from the highest high to the lowest low. You should get this in first 30 minutes of session. You should change your Fibonacci settings like ICT has it on, and we will continue doing the same for the remaining 2 sessions and look for the price extensions level and observe how does price behave at these levels. We have disruption here, and now we are having the same thing below. This indicated price might target this swing high because now we have jagged price action at the bottom and relative equal highs on the above. We have inefficiency here, and this could be immediate rebalance. Immediate rebalance when we have extended range that goes up and then drop goes back, touches the candle high and runs above for the inefficiency and liquidity. We also have this fair value gap in this. I want this to be open and act as breakaway gap and reach for that level above. We will be observing this last leg up on 15-second chart. Let's see if we had missed an entry on 1-minute chart, then did 15-second offer some entries or what? This is the immediate rebalance, so ICT puts the line on that and it highlight on 15-second chart also. Now we will be observing the price action here on 15-second chart. If you look at what is happening here, it traded up and coming right back down. What is occurring there? Coming right back down and rebalancing the inefficiency of this quick, sudden price run. Knowing the algorithm is repricing here, we have relative equal high here and fair value gap here. Price went above and took buy-side liquidity. Price comes back to fair value gap with 1-minute immediate rebalance. So it's first return and after taking buy-side liquidity, but we will not anticipate price falling down because we have not met the objective, which is this high. So this drop give you opportunity for 15-second long. For me, if anyone had already bought at the lower prices, then this is where ICT will add one more contract. Suppose we had missed this entry then on 15-second, we have another long here, and then this small FVG here. Smaller time frames provides more opportunities. It does not mean that we should start just trading on 15-second chart. We need context in the narrative with it. ICT put emphasis on doing tape reading, which is simply observing the price action from 7 to 10 in the morning, and mark your levels and see how price behaves there, and journal everything. If someone is trading and did some mistakes, note that down, but do not curse yourself in your journaling. Do positive self-talk. There. As traders, we usually prefer to take trades when there's a significant news event that can move the market. However, today's economic calendar seems pretty quiet with no major high-impact news scheduled in the morning. But today, there's a bond auction happening in the afternoon, 1 p.m. So, instead of trading earlier in the day, ICT shifted our focus to the afternoon session. Next up, we'll be marking the new day opening gaps, and we'll have 5 of them to work with. If we have a new day opening gap that forms on Tuesday, ICT might mark this as the new week opening gap Wednesday high and date after that. At 7 a.m., we find ourselves trading well above the new week opening gap. But here's something to keep in mind. These gaps tend to have a magnetic effect on the price. Even though we're currently above it, the price could very well come back to these gaps multiple times throughout the session or in another session. In this scenario, we have a gap down where the price closed at 5 p.m. and then opened below it. But if we look closely, we can see that the price moved around the gap, leaving a portion of it unfilled. This unfilled area indicates missing sell-side delivery, which is crucial to note. These gaps, especially when partially unfilled, tend to exert a magnetic pull on the price. We'll place a Fibonacci extension on the gap and add the 0.25 and 0.75 levels to it. We divide the gap into 4 quarters. Interestingly, price within the gap tends to respect these levels. At 7 a.m., we were trading significantly above the new day's opening gap. However, after the bond news was released at 1 p.m., the price eventually filled the entire gap. ICT mentioned that this is gold dust and should definitely be noted. When we have 1 new day opening gap above the price and 3 to 4 new day opening gaps below, it's a strong indicator that the market is likely to move towards the downside where the clustering occurs. However, remember, this isn't the only factor in determining a bearish market. We need to consider the overall narrative and other price signatures, to build a comprehensive view of the market. When referencing 7, 8, and 9 a.m., we analyze what the price is likely to do based on relative equal highs and lows. If the new day opening gap is significantly below the current price, we should anticipate that these highs are likely to be taken out. Consider that above these highs, there's buy-side interest, with buy-stop orders resting there. After 9 a.m., the market may rally, creating small swing highs and relative equal highs. Following this, the price often breaks down, forming another relative equal high. This pattern indicates that the price is engineering liquidity. Now, for those with a deeper understanding and experience from following ICT, we will refer to the previous session's market. We have this low here and another one here. What does it make relative equal low? Do you remember the criteria for choosing high probability or relative equal lows? They should reflect as prices making higher low. That means right one has to be higher than the previous low. This low could be used as a target around that bond auction. Here ICT is showing his trade. He took with narrative aligned with the bond auction. He has taken this trade about 15 minutes before the news. Anticipating at news, algo will push the price down. We have relative swing low from London and new day opening gap below that. This candle traded up, and ICT wanted this candle to be very reactive when it enters into the inefficiency above. This is another important point, and ICT asked us to note it down. Some of the most common questions ICT gets: what will he do? If he is not trading this fair value gap, how did you know price is going to do this and not going to other direction? We're expecting some key news to drop shortly, but before that, let's analyze the current price action. Take a look here. We've just made a lower high, and notice how the body of the candle is respecting the fair value gap. This is a critical area because we're seeing the price start to move down from here. Now, let's shift our perspective as if the price action on the right hasn't printed yet. If we're in this situation, our understanding should be that the price is most likely to target this low here. Why? Because that's where the liquidity is sitting. But before it can do that, remember, the price has been trending down all day. It hit a point here, stopped, then retraced all the way back up before moving lower again. Now, it's crucial to keep in mind what's happening at the bottom. We've got a new short-term low forming, and this becomes our first target if the price is going to head down to that new day opening gap. This low has sell-side liquidity, which is what the market might aim to take out next. So, as always, watch these levels closely and stay sharp. The market's telling us a story. Our job is to listen and act accordingly. Now, some of you might be noticing the relative equal highs here and wondering if they pose a concern. But remember what ICT mentioned. Those highs shouldn't bother you. The market is clearly moving lower, pulling towards the new day opening gap. Even if the price doesn't trade there during today's session, the focus remains on where the liquidity is. So, what are we left with? It's the sell-side liquidity and the London session's relative equal lows. These levels are key. We now have these three critical points: this low, and this low. Together, they make shorting a high probability move, with the price likely to draw towards them. The alignment of these factors makes it clear that the market's intention is to target these areas. This is a prime moment where we should see the market start to run, especially with the bond auction starting right around here. We're positioned up here, and there's a strong likelihood that the market will take out this sell-side liquidity and potentially target the previous session's relative equal lows. Now, when the price was here, ICT was closely watching to see if the price would go above the fair value gap and touch the midpoint of the gap. The price came pretty close but didn't quite touch it, and then it closed below the fair value gap. This is a clear signal that ICT recognized as the formation of a bearish order block. When the second candle right after the up-close candle touches that up-close candle, that's a strong signal to short. What ICT is looking for here is for the price to move away and then come right back up to this level. It's crucial that this candle isn't overtaken, and the next candle falls short of the one that touched the fair value gap. If that up-close candle had reached the midpoint of the fair value gap, ICT wouldn't have taken this trade. Instead, he would have waited for another candle to move up and reach the remaining inefficiency in that fair value gap. While PD array often used for setting static levels to enter and exit trades, ICT also uses these price levels to measure the market's strength and weakness. For instance, if this candlestick can't even touch the fair value gap, that's a significant signal. This inability to reach the fair value gap is a signature move that indicates potential weakness. When this candle closes, all you need to do is watch for when the price moves away and then comes back to touch the bottom of that candle. This setup forms a bearish order block.
We have target here, as we already know, the sell side liquidity.
As price comes back to the order block, ICT sells short. Now, ICT often emphasizes observing how price interacts with these gaps, especially when the consequent encroachment of the lower gap hasn't been touched yet. Take a look at the chart. Notice that we've got two fair value gaps, one here and another one higher up. What we need to anticipate is the possibility of price pushing up to fill the higher fair value gap. But what if it doesn't? What if price fails and instead retraces to the lower fair value gap? If that happens, the lower gap's consequent encroachment becomes a critical level to watch. And with a news driver on the horizon, there's an added layer of confluence. However, ICT not shying away from this trade. ICT actually took a position from the order block beneath this fair value gap. Now, ICT wanted to see this upper fair value gap open, and crucially, he wanted to see it fail to reach the midpoint of the lower fair value gap. This is something we need to pay close attention to. If the price had touched that midpoint, then I would be expecting the candle to push into the left inefficiency within this fair value gap. In that case, my stop loss would be placed just above the midpoint of the fair value gap. These are the kind of logics we need to build our trading strategies on. It's not just about reacting to what the market does, but anticipating these key levels and structuring our trades around them. After price dropped, we saw an immediate rebalance. The market traded down, bumped here with that immediate rebalance, and while ICT was taken into a little bit of drawdown on the second portion, he was still profitable at this point. Why? Because he initially shorted 6 contracts, a larger trade, and then added 4 more. Now, price could have reached further into this fair value gap, but ICT wanted this gap to remain open. Price did push up to that level, but crucially did not touch the midpoint of the fair value gap. This was a confirmation of our narrative that the algorithm is in a sell program, and price should now target the relative equal lows formed during the London session. At this point, the only thing we needed to do was to move our stop loss to break even and let the trade do its job. When price reached 1 o'clock, we saw exactly what ICT has been teaching us. The algorithm pumped first, catching traders off guard, and then dumped it. ICT mentioned in his last lecture that when we anticipate price to be in a sell program, we need to mark every significant imbalance. Here, we could have had another opportunity. This scenario perfectly illustrates the importance of understanding how the market structure and algorithmic behavior align with our trading models. If this breakdown helped solidify your understanding, then be sure to check the description below. So today at 8:30 in the morning, we have employment data coming out, and we'll be observing how the price reacts. Now, ICT doesn't focus on the actual numbers from any news release because the charts tell the real story. It's all about watching how the market responds and aligns with our analysis. The lines you see here on ICT's charts are crucial reference points. The blue lines represent the new day opening gap, while the red lines indicate the new week opening gap. The midpoint of both these gaps is what we call the consequent encroachment, a key level that ICT focuses on in his analysis. Look where the price is sitting right now. It's below yesterday's new day opening gap and above today's new day opening gap. Even though we have news today, ICT has advised us to focus on the price action around the new day opening gap and new week opening gap layout on your charting software. He emphasizes that, regardless of the news, the algorithm will be spooling the price at 8:30. Time is the main piece of ICT's trading model. When dealing with new week opening gaps or any other significant range of gaps, ICT advises us to divide these gaps into quarters using Fibonacci levels. We can see here, candles are respecting the high of the gap. Price comes back down and pulls back to the low. Then price rapidly goes down. Where's it reaching to? The gap below, and respects its consequent encroachment. Price goes down again and comes back up to the low of gap within fair value gap and drops below. Here is the Wednesday gap. Look again how bodies are respecting it. When price comes back up, it stops again. Where? At consequent encroachment. Now the news which we were waiting kicks in. Look at this beautiful price delivery. In the last lecture of ICT, told us about the clustering of gaps and what we should anticipate with price out, if you remember. Price will gravitate towards where there are more gaps, or I should say cluster of gaps. And price is doing the same. Is it not great to witness this? We should always be on the lookout for turning points in price, especially in these scenarios. It's crucial to ask ourselves why the price moved from a particular level. Understanding the reasons behind these movements helps us align our analysis with the market's intentions and enhances our ability to anticipate future moves. When we see the price coming back and stopping at the first quarter, followed by a strong displacement, it could be an indication that the algorithm might be shifting into a buy program. After displacement price comes back and ICT likes the fact it did not touch the new day opening gap, sets the tone for prices going to the gaps above to offer the fair value. If the price keeps spooling before the official market open at 9:30, ICT's approach would be to hold off and not take any action right away. Instead, he'd wait for everything to align, specifically with time. The macro, which occurs 10 minutes before the hour to 10 minutes after, and with, in the morning, silver bullet. Additionally, he'd look for other confirming factors, such as a bullish market structure shift, before making a move. As the price moves upward, we need to anticipate the next level it might reach. To do this, we can use the Fibonacci retracement tool and look for fair value gaps in the premium zone. We have one right at the 50% level, but ICT prefers the one above it because it's formed in conjunction with a breaker. This combination adds more weight to that level as a potential target. If we identify a breaker that has a high low and a higher high, and it has taken out the buy-side liquidity, we need to pay close attention to what happens during the run-up. If this move leaves behind a fair value gap, this area becomes crucial. This gap will act as an inversion fair value gap. Now, let's observe the price action on the 15-second chart. Right at the news release, the price moves around 52 handles within just 15 seconds. It then runs towards the Wednesday gap, followed by the Tuesday gap. Above that, we have a fair value gap at the 50% level, and even higher, we find an inversion fair value gap. Here's what we're seeing. The price rallies up and then trades down. Notice the overlapping of these candles. The high of this candle is where we opened and traded down. This move took us to the consequent encroachment of Wednesday's gap. Once the price touched this level, it then rallied, leaving behind a bullish fair value gap. Now we have some reference points for where the price might head next. The Tuesday gap and the fair value gap above that. There's the range between trading on this fair value gap and this repricing too, and how far this can overshoot this gap. Look at the overlapping here, where these two body agree to close this and open on other one. That right there is PD array. Price can touch that perfectly. Open of this candle and low, this candle is same. After the initial rally, we see the price create a small volume imbalance inside the bullish fair value gap. Our focus now is to observe whether this imbalance stays open and price support, or shows an inability to trade back to the midpoint of bullish FVG. If it does not manage to touch the midpoint, the price might shoot up immediately. Next, we see that the consequent encroachment, CE, of the fair value gap is established, and the price trades down to the first quarter before rallying again. This is a positive sign because it leaves the volume imbalance open and does not return to the CE. As the price starts to rally, each down close candle should act as support and function like an order block until it reaches the high of Tuesday's gap. The market then trades back down into the bullish order block and starts ranging around the gap. If the price begins to move lower and drops below this low, my strategy would be to stay put until the 9:30 open and avoid any impulsive entries. When the price is at these levels, it's crucial to analyze whether there's a chance for continuation in line with the higher timeframe narrative. Assessing the higher timeframe, such as daily or weekly periods, can be very useful here, and cancel for the anticipation of bearishness. This is something you will gain with experience. If you're a beginner, ICT suggests analyzing the price action by asking these key questions. Will the price trade into the fair value gap and then reverse, heading towards the inefficiency above? Or will the price take out these lows before moving to the higher target? Alternatively, could the price completely reverse and trade back to the 8:30 open candle? Does price want to reach the upper fair value gap before 9:30? Remember, you can do all this analysis and reading without putting any money on the line. This process helps you understand market behavior and refine your strategy. It's essential to recognize that you may not always be right, and trading takes time and practice to master. Get quick rich decisions can derail you, rob you from the opportunity of a lifetime. We have a volume imbalance, and we've touched the top of the gap high. Within this context, we see two small arrays inside the order block. Now, we need to observe whether the price wants to run above this high and move towards the gap at the top. This could indicate a continuation pattern or a move towards the next level above. Price is going as it was anticipated by ICT. It's all about understanding where we are at within this range. You can clearly see that this is the range high, extending all the way down below. This is the most recent significant directional move occurred before 8:30, and it's important to recognize where the most profitable traders are positioned now. In this case, it's clear that the profitable traders are holding short positions. After the news driver and with a cluster of gaps above, the probability increases that the algorithm will aim to take them out. This suggests that the market might be gearing up to target those levels above. So now we are on 15-second chart, price touches the CE. ICT told this level before it happens, and it hit here. So what's happening? It having resistance, then it breaks down this level, this low. After it touches this, price trade down below. What does it mean? Shift in the market structure. So what is it going to do? So probably it's going to trade to short time premium. So what it's going to go? Trade to, when you see this gap there to there, look how bodies are respecting the FVG. Wicks can do the little damage, how far this can do. You see this volume imbalance, and where it trades down to low and of the Tuesday gap. So the key takeaway is when you have FVG and small volume imbalance above, this tells where the wicks can go. How can you trust the trade is still viable? Or if you miss the first down move, can we enter a gain here? Yes, it's reclaimed FVG. Let's zoom in here. Look how the bodies of candles are supporting the fair value gap. Look where the bodies are, what wick are doing little damage. To what degree is that wick going with underlying expectations? Look back. Left, what do we have? A short-term high? Did wick went above that? Yes. How far above that wick can go up? Again, look to the left. What do we have left with? Volume imbalance. Here, price fails to go to the CE. This is what we should be looking for. We want to see the next candle dive below it. Does it? Yes. Now we can use this as an institutional order flow entry drill. Price moves, trades up to the gap, and we want to see that open and act as a breakaway gap. From here, the price fell sharply, taking out all the sell-side liquidity that was engineered during the morning session. How far did it fall? Right to the consequent encroachment, CE, of Wednesday's gap. The algorithm first punished the sellers by pushing the price above, and then it dropped, punishing the buyers before ultimately moving to a new high for the day by far. Finally, price has reached to the level ICT has given us earlier, an inversion fair value gap, which is a first fair value gap within In this lecture, ICT teaches us how to approach trading during the Asian session, which runs from 7 p.m. to 9 p.m. Let's break this down step by step. We begin with the 5 o'clock candle close, followed by the 6 o'clock candle. The difference between these two candles represents the new day opening gap. This gap is less than 20 handles, and since there is no medium or high impact news today, we're in a low news environment. It's also Friday, and we have a large weekly range in play. After marking this gap, our objective is to observe how the market creates motion around it. As the market moves, we notice the formation of a high, followed by another relative equal high. We mark these highs as they represent buy-side liquidity. Once the market opens and moves above these levels, we identify a minor buy-side liquidity pool above and a minor sell-side liquidity pool below. The price action we want to observe is for the price to move above the gap, then retrace below it. As it moves downward, we want to see short-term lows taken out, which does indeed happen. Now, with both short-term liquidity pools above and below the new week opening gap, this leaves us with a new range of initial buy-side and sell-side liquidity after the 6 o'clock candle. It's important to note that when the price trades in a tight range after the market opens, it often signals that the Asian session will be quiet, and we should avoid trading in such conditions. Outside of these initial liquidity pools, we should look to the left side of the chart to see if there is any additional liquidity. In this case, we find another buy-side liquidity level, which we also mark. As we approach 7 p.m., the official start of the Asian session, we place a vertical line on our chart. The market then moves above the new day opening gap, but it does not take out the low. Before crossing this level, the price exhibits significant energy, and at 7 o'clock, it touches the high of the new week opening gap. When this occurs, particularly after a displacement, it signals that the algorithm is giving us a clear indication. With the element of time now in play, the market should displace above the relative equal highs and aim to take out the buy-side liquidity. At this point, everything is in motion, and the price shows no intention of moving lower, signaling that we are now fully engaged in the Asian session. We notice a bullish fair value gap, and when ICT is looking for buys, he prefers that these gaps remain open and act as breakaway gaps. Following the retracement candle at 7 p.m., it takes just 9 minutes to take out the initial buy-side liquidity. After the price clears this level, ICT expects it to accelerate quickly, as if it's fueled by rocket fuel. If it lacks speed and magnitude, we could be dealing with what ICT calls turtle soup. After the gap up, the price retraces and trades back to the main candle, which presents an excellent entry opportunity, a great buy. However, ICT had already taken his entry before the initial buy side was taken out. He anticipated that the down close candle would act as an order block. Important point to remember that price first left volume imbalance, then retraced below. This made ICT enter just below the close, at 18,599.75, with a stop loss placed below the consequent encroachment of the breakaway gap. So far, the price has taken out minor buy-side and sell-side liquidity, leaving the initial buy-side and sell-side liquidity intact. The price then moves above the gap, displacing just before the Asian session starts. These are the elements that should align before making a move. From my experience, it's easier said than done, especially for anyone new to trading. Patience is crucial. Give yourself time to learn and wait, just as ICT does. To anticipate how far the price might go after taking out the buy-side liquidity, we can use the Fibonacci tool to measure potential targets. We can look at the -1 deviation as a potential major move or target the midpoint between -1 and -1.5 as well. This can also be done graphically on the chart. By marking these levels daily, you'll learn how to refine and adapt your trading model effectively. In Asian Session, ICT also mentioned how he teach in the core content mentorship that how can we trade by fading the bull flag, which is a very common pattern in retail community. People usually wait for the price to break out of the flag and make a new high, often aiming for a move similar in range to the last leg. Price clearly did not follow this pattern, and instead, we had a bearish ICT entry after a market shift. We could have entered at the fair value gap, targeting the initial sell-side liquidity, the highs, or the new week opening gap. Now, if you're trading the London session, which starts at 2 a.m., it's important to mark the opening range between 12 and 12:30 a.m. For the Asian session, we focus on the new day opening gap. But for London, we look at the highest high and lowest low between 12 and 12:30. These levels serve as critical reference points for the session and extended it until 4 a.m. ICT recommended trading the London session from 2 to 4 a.m., sometimes extending to 5 a.m. for Forex, but I believe this can be applied to futures as well. Let's break down what happened here. From 12 to 1 a.m., price moved down, a bit of a fake out to throw retail traders offside. Then, as we entered the London session trading range, price took the sell side liquidity and traded in a range for a bit. We then saw an energetic bullish candle here. The price retraced slightly, moved again, and left a volume imbalance. It retraced to the volume imbalance and went to the low of the 30-minute range. I see a few potential entries here. After the London session chop, there was significant sell-side liquidity. Price took out the sell side, retraced to the fair value gap, with a volume imbalance within this order block, which is within this larger order block. And by the end of the session, at 4 a.m., price reached the upper side of the range. These initial buy-side and sell-side levels are crucial, and Algo refers back to them during the New York session as well. In the New York session, now, we'll mark horizontal lines at 7, 8, and 9 a.m. to track these key levels. Between 7 to 8, ICT mentioned a potential reversal, which aligned with my analysis. Price action triggered buy stops, created a higher high, then displaced, breaking below initial buy-side liquidity and reaching the initial sell-side liquidity. We could have taken possible institutional order flow drill entry here at 2 past 8 if we had missed the initial move. A second shorting opportunity presented itself. The third candle pierced below the previous low and then retraced back above the volume imbalance area. Taking a short position at this point would have resulted in a profit as price eventually reached the new week's opening gap low. If you secure a profitable trade before 9 a.m., consider it a successful session. However, if you cannot trade that, focus on the post-9 a.m. trading hours. The gap between the previous day's close and the new day's open becomes crucial during this period as we transition from electronic to regular trading hours. When we encounter a significant gap down, especially one around 100 points, ICT's insight about gaps becomes particularly relevant. According to ICT, in such scenarios, there's a 70% chance that at least half of the gap will be filled during the trading session. After the price took out the lows and displaced above, yet still left a portion of the gap unfilled, this unfilled area becomes particularly significant. According to ICT's principles, the remaining part of the gap represents an area lacking buy-side delivery, making it a potential draw for liquidity in the future. To complete the objective of reaching the draw on liquidity, the price action strategically engineered the liquidity. It did so by taking out the sell-side liquidity, displacing above, and then retracing to a fair value gap. This move allowed the market to fill the objective, reaching the remaining portion of the gap that was initially unfilled. I'm working on PDF notes for the ICT 2024 mentorship to make it easier for you to study and revise these valuable lessons. If you're interested, be sure to check the description below for more details. If you're enjoying these summaries or have any constructive criticism, please let me know in the comments section. Your feedback helps me improve and deliver better content for you. Thanks for watching.